In this week's video, we'll explore the question, are stocks beginning another painful leg down? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Kathy and I are heading to the Georgia Tech Notre Dame game tomorrow, so I'm recording this week's video from a hotel room in Chicago. So if the audio and picture quality is a little bit off, please bear with us. Next week we'll be back to our regularly scheduled broadcast. Now we're looking at a monthly chart of the S&P 500. This is a DeMark chart. DeMark charts and indicators are proprietary tools from Market Studies LLC. Why are we migrating towards a defensive portfolio? Under our system, we stay with the primary trend, which right now is down, and we don't make any assumptions as to how long the primary trend can last. It can last weeks on the downside, months, or years in the case of a bear market. Point of the exercise here. This is a DeMark propulsion magnet. It's telling us that based on ebb and flow, mathematically in terms of the way markets work, the upside potential on the S&P 500 is near this teal diamond here at 2024. The downside potential, looking out days, weeks, and months, is all the way down at 1680, which is about a 14 or 15% additional loss from where we closed on Friday at 1958. This is not a prediction, it's just understanding and respecting the ebb and flow of markets. Remember, this week we looked at Fibonacci retracements. We can use Fibonacci retracements for any time frame, including the big gains made by the S&P 500 over the past few years. It's normal to retrace those. So it's possible that we could come down quite a bit further. As always, we'll keep an open and flexible mind and stay with the primary trend until the evidence changes. This is the weekly chart of the NYSE composite that we've been using to build the bullish case, but while we were doing that, we said our concerns would increase if price dropped below this blue line here. We've closed below that blue line for several weeks. Let's use this chart to understand how the market model works and a little bit about fractals and reasonable expectations. Longtime viewers and clients know that the market model helps us discern between volatility to ignore here because the primary trend is still up on this time frame, and volatility to respect that requires action because the trend is now rolled over from a bullish trend to a bearish trend. Peaks and trend reversals on any time frame are difficult. So something like this is difficult. The market model can't make this market, can't change the complex of the market. The whole purpose of it is to help us navigate through a difficult market and make the necessary adjustments to get properly allocated for what could be the next leg down. It always feels uncomfortable in here, and it always feels uncomfortable in here. Typically, when you see something like this, and this, and this, something like this follows. Not necessarily this type of magnitude. So everything that we can look at on this chart, long term, the trend is up. On this time frame, this is volatility to ignore because the primary trend is up. We've passed volatility to ignore now, and we've moved into volatility to respect. Moving averages and charts help us smooth out all of this volatility. Now, everything that we just said about this daily chart, and we're talking about long-term trends on a yearly time frame here, applies to any time frame. A pattern like this can occur regularly on a 1-minute chart. A 5-minute chart, a 10-minute chart, a 60-minute chart, and in this case a daily chart. If we go out longer term, we could use weekly, monthly, or quarterly charts. Fractals tell us that we always have a primary trend going on, and then we have counter trend rallies. A primary trend in this case is down, and we have counter trend rallies. The primary trend is up, counter trend rallies, the primary trend is up. Same thing is true on a 60-minute chart. So the purpose of saying that is, if you're going to ignore volatility and ride trends, it means by definition during the counter trend rallies it's going to be frustrating. So little mini bull and bear markets are happening multiple times every day when you look at 1-minute charts. So you can never be 100% comfortable and 100% on the right side of the market. Markets just don't work that way. To stay with the trend, you have to hold through the counter trends on your time frame. When we move from a trend to a trend reversal, this can be confusing and painful because the market is confused. But if you get yourself properly allocated, you can participate in the next move. If you get yourself properly allocated, you can participate in what could be the next move. We could retrace, a normal Fibonacci retracement of a gain like this could take us down into these areas here. We'll head into next week with a flexible, unbiased, and open mind. Now let's take the exact same concepts and apply them to the 2015 market. This was the chart we covered last week as of Friday, September 11th. Your primary trend had rolled over to be a bearish trend. We said that we had to be mentally and emotionally prepared for a counter trend rally that could move back as high as this area here, or even a retest of the blue and red 200-day and 50-day. So let's fast forward. What happened this week? Did we get a normal counter trend rally? The answer is yes. This may be difficult to see. During the week here, we moved, this is an intraday move here, we moved all the way up to the area that we said we might move to. That wasn't a prediction, it was just an understanding of how markets can and might work. What once was support may now act as resistance. We came right up into that area. What once was support may now act as resistance. We came right up into that area. This Fibonacci retracement tells us this is the low. This move from the high to the low, it is normal and healthy to have a retracement. This is a normal counter trend rally to go to the 38.2, the 50, or the 61.8. We had the three things intersect right here. Does it always work that cleanly? No, it doesn't always work that cleanly. These are helpful. This is possible resistance, and as we head into next week, it's still possible resistance. Nothing says that we can't move into this area here. From a probability perspective, these are not good-looking candlesticks, especially when you consider we're in a downtrend. We had a normal counter trend rally, and we reversed at a logical level. Similar concepts here. This is a chart from last week, horizontal. What once was support may now act as resistance. How did the same chart look at the end of this week? This is a week ago. Similar situation here. We said if we cleared 1993 that there was somewhat of a gap here last week or during the week, and we could move all the way to 2022. If you look closely here, you can see this is the wick on the candle. Intraday, we moved exactly up to that level there, and price was rejected, and we closed back in these bands. Friday, we have an ugly looking candlestick, and we closed below all of them. All things being equal, this is telling us that the probability of this downtrend resuming, so this is somewhat a leg down, a counter trend rally, and then a leg down. Whether or not we make a lower low remains to be seen, and whether or not we even move into this area remains to be seen. No predictions, we'll just pay attention to the observable evidence, but these are ugly looking daily candlesticks. If you didn't see it, it's worth noting that there was a post on Short Takes this week that is great for chart study. It compared trends in the current 2015 market to trends in 12 other historical cases, and the charts are described. You can Google Short Takes and look for the link that takes you to shravacocapital.com, and this is the post that you're looking for. Regular viewers and clients know these are some of the weekly moving averages that the market model uses. This is what maximum fear looks like. This is what maximum confidence looks like when price, the S&P 500, is above both moving averages. Blue is above red and the slopes are up. In this case, you've got price below both moving averages. Blue is below red and the slopes are down. How does the exact same chart look today? The answer is we close below all the resistance levels after a wild post-Fed ride. It may seem hard to believe, but the S&P 500 actually closed in the red this week. It lost 2 points. At the end of the week, we had price below both moving averages, blue below red, and the slopes were both down, telling us that this is more of a low probability look. We want to see this chart morph into something like this, and then we'll begin to scale back in with our cash. When that occurs, it's anybody's guess. We don't need to predict that in advance. We'll just pay attention to the hard and observable evidence and ask the question, are we currently allocated properly? If the answer is yes, leave it alone. If the answer is no, we'll make the necessary adjustments. Same concepts here. We're just using longer duration moving averages. Full bore bearish look is when the slopes of all of them are down. In blue, the fastest moving average is on the bottom and price is below all of them. How does the same chart look today? Does it look more like this or this? The answer is it's not even up for discussion. Blue is below all the moving averages, price is below all of them, and the slopes are all down. We don't have any bullish moving average crossovers here, and we don't have any of the slopes turning up yet. We'll wait to see observable evidence. We can see changes here. We can see these changes that started to take place in March of 2009 when the weekly chart started to bottom. After that, from a probability perspective, good things tend to happen. This is another set of charts that we need to see improve before we can start redeploying capital. This is stocks risk on relative to a diversified basket of bonds. In this case, it's a Vanguard mutual fund. This is a monthly chart. This is the ratio rolling over. Here, in the year 2000, we have a full bore bearish look with the ratio below both moving averages and blue below red, and the slopes of both are down. Here in October, wouldn't you have liked to have been given a little memo that said cut risk in October of 2007? Well, here, this is observable. I don't need to predict it. I can see it. The ratio of risk on relative to risk off drops below the moving averages. Blue drops below red here. That does come later in the year, but before calendar year 2008, and the slopes of both are down. How does the exact same chart look today? This chart doesn't tell us anything about how the rest of the month will play out. It's only the 17th of September in this case because the mutual fund has not settled yet on Friday the 18th, but the chart will look very, very similar, if not a little bit worse, because bonds were up on Friday. We don't know how this will look at the end of the month. It could improve, but we need to see it improve. We don't make any predictions as to how long this will last. In this case, it lasted literally years. This is 2000. The stock market doesn't bottom until October of 2002, and it really doesn't find a permanent bottom until the spring of 2003, almost 3 years later. In this case, in 2007, we don't know how long this look will look like this, but we don't need to know that. In this case, the stock market fell over 50% from peak to trough. Can a correction look somewhat like this? Absolutely, positively, yes, it can. It doesn't mean we're going into a bear market, but we don't make an assumption about the length of time, because if we do that, it brings bias. All we need to do is to continue to ask, what is the observable evidence, the rules, and the model, and the hard data telling us today? And then, are we allocated properly? If the answer is yes, we're in good shape. We'll head into next week, as always, with a flexible, unbiased, and open mind. Price will guide us if we're willing to listen. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.